Think your Social Security is tax free? It might not be. In episode 23 of Retire Stronger, we reveal how up to 85% of your benefits could be taxed and what to do about it. Learn how to keep more of what you've earned with smart, tax efficient planning.
Hello and welcome to Retire Stronger, episode 23. I'm John Foard, and with me today, as always, is Bill Kearney. Today, we're going to talk about how you've paid into Social Security your whole life, and now it's time to collect. But what most people don't realize is that Uncle Sam may still get a cut, even after you retire.
Hey, John, good to be with you. Yeah, that's right. Believe it or not, Uncle Sam still has his sticky fingers inside the plan here. And in particular, we're talking about Social Security and how it can be, the income of that can be taxed. And for many high income retirees, up to 85% of your benefit could be subject to federal income tax. So in today's episode, we break down what nobody told you about Social Security and taxes and how to plan smarter.
That's right. Again, this is Retire Stronger, the podcast where we help you retire smarter, more confidently, and with greater peace of mind. So, Bill, start us off here.
Yeah, Social Security is not automatically tax free, despite what you may have thought or heard. I think it's one of the biggest misconceptions on folks when they come into our office, at least, or people that we talk to, is that Social Security benefits are always tax free. And while that may have been true decades ago, it's not true any longer. As a matter of fact, it's been about 40 years now when that changed. A bipartisan reform bill made up to 50% of your Social Security taxable. And then in 1993, a further overlay increased that cap to 85%. So, John, just to clear this up, this doesn't mean that you're paying up to 85% in taxes or that you're paying taxes at an 85% rate. It means that up to 85% of your benefit is counted as taxable income. So quick number there, if you have $1,000 a month benefit and you're in the 85% provisional tax here, then that $850 of your monthly benefit can be counted as taxable income.
That's correct.
And the problem is that the income thresholds that determine how much of your Social Security is taxable have never been adjusted for inflation in 40 plus years. So as retirees have more savings and pension, more people are subject to these taxes, even people who aren't wealthy by today's standards.
Yeah, and let's just real quick. Also, we might have some people in the audience wondering, why are we talking about Social Security? I'm in my 40s, I'm in my 50s, I'm not even close to starting to consider withdrawing or acting on this benefit, assuming it's still around when they're able to do so. And the reality is that's the perfect time when you can start doing some planning to help avoid exactly what we're talking about right here. And I think what we need to do is we need to dive in first and talk about what is provisional income. So understanding how Social Security is taxed starts with something called provisional income. And this is the special formula the IRS uses to determine how much of your benefit will be taxable. So here's what counts right now. This is how the law sits today. What counts as provisional income? Well, would you believe it if I told you, Bill, that 50% of your actual Social Security benefit is actually added into this calculation? It almost seems like they're triple taxing this thing at this point, is what it feels like. But let's say, for example, you have we'll use easy numbers here. Let's say you have $30,000 a year in Social Security income. 15,000 of that, or half, 50% of it, will be added to this calculation. And then all of your other ordinary income will be added in, like any wages you might have from any jobs you're still working while collecting the Social Security, any traditional IRA withdrawals that you may pull out of an IRA, that will count towards it, and also any pension income. And then you got to add in interest from taxable investments. So if you own any CDs at the bank, or if you have some high yield savings accounts and you have significant dollars in those types of accounts earning interest every year, that interest income will count towards this calculation as well. And then if it's not bad enough already, if there's anyone out there that is considered maybe looking at buying municipal bonds or already own them, the bond interest, yes, even though it's tax-free interest, that bond interest will be added to this calculation for what counts as provisional income as well. Now, Bill, I'm going to pause there before I kind of go into an example, a very short, easy example, or kind of talk a little bit more around what the thresholds mean. Is there anything you want to add to that bit of information I just shared?
Yeah, absolutely. Because I am not going to let Congress off the hook here. Okay.
I agree with that.
So let's go back in the time machine here. Let's get in the DeLorean and go back to 1983. In 1983, Congress came to the president and said, hey, we've got a problem. Social Security is out of money. And the solution was to change a few numbers at the Treasury Department and come up with this tax calculation called provisional income. Okay. Now, this provisional income calculation set these limits that John's going to go into here in just a minute. And the key component here is that these provisional income thresholds have not been adjusted for cost of living since 1983. So automatically every year they're scooping up more people into the highest bracket because they just didn't put a cost of living component in this. The point behind all of this is that this is something that catches a lot of people off guard. So please pay close attention to what John's going to talk about next so that you can hopefully figure out initially here which bracket you fall into and how you might calculate how much of your Social Security income is going to be taxed.
Yeah, let's just dive right in. So once all of that income is added up and your provisional income is calculated, it's compared to thresholds or to a threshold, possibly more than one. So for an individual filing, his taxes as an individual, that threshold is $25,000. And for married couples filing jointly, it's $32,000. So if you're over those limits, so if your provisional income as an individual, if it's higher than $25,000, or if you're a married couple filing jointly and it's higher than $32,000, a portion of your Social Security becomes taxable, and it's up to 50% initially. And then it goes up to 85% as potentially taxable once your provisional income hits $44,000 if you're a married couple filing jointly, or if you are a single individual filing single, it's $34,000. So when you think about that, it really does kind of it's upsetting. And I agree with you not letting Congress off the hook here. We have a COLA adjustment for your income you receive from Social Security every year. So now, like, why does this not have it, right? And when you think about that, regardless of the amount it goes up, every year when your Social Security increases by the COLA adjustment that they give you, that just adds more and more money to your provisional income, because half of that adjustment, half of that increase gets added to your provisional income. So they know that your income is going to continue to increase no matter what every year, most likely, or at least from that source. So yeah, it's frustrating. So you have very low income limits.
Let's put this in perspective, John.
Yeah.
I'm going to ask, we'll play a little guessing game here real quick. How much in today's dollars do you think $25,000 was worth in 1983? So in other words, how much could you buy today, or in today's dollars, what's the equivalent to $25,000 from 1983?
Oh gosh, I mean, you'd have to do the calculation on inflation, but I would say it's probably a third, maybe half.
Okay.
Compared to today.
The purchasing power on that in 1983, $25,000 in 1983 is equivalent to, the Google machine told me this, so I'm assuming this is correct. Just under $81,000.
Yeah, so I was closer on my third of it, guess, versus half, but I was still off. I mean, it's you have to do the calculation on the inflation and how it's impacted. But that right there tells you if the calculation was 25,000 back then, it needs to be in the 80s today. That's where it should be.
Correct. If it was cost of living adjusted with inflation, that 25,000 bracket would be just under $81,000 today.
Yep.
So we're talking about the fact that the highest bracket, the 44,000 bracket, is half of what the 25,000 bracket purchasing power is today. So
Yeah, what it
obviously,
should be. Hmm.
obviously the intent was to catch as many people in this net as possible. So let's talk now for a few minutes about the impact here. Okay. So if your provisional income is low, let's say under $32,000 a year, and I'll be candid with you, we don't see a lot of this, but if it is for a couple, you might not owe any federal income tax on your Social Security. Now, just stop here for a minute. There are ways for you to draw the same amount of income that you want to draw, but do it in such a way that it does not impact your provisional income calculations. That might seem crazy, but it's possible. It's creating multiple streams of tax-free income inside your plan can do this. So it may not be what you look like today, but there are options and there are ways for you to actually structure your plan to make your provisional income as low as possible. Once you cross that line, though, once you cross that provisional line, the taxability kicks in quickly.
Very quickly.
For example, let me give you just an example with some numbers here. Let's say married couple receiving $40,000 in Social Security, taking another $50,000 out of an IRA. That puts provisional income well above the threshold.
Yep.
And 85% of their Social Security benefit now could be taxed. Okay,
That's right.
And keep in mind, this doesn't even touch state taxes. While most states don't tax Social Security, there are still a dozen or so that do, like Colorado, Minnesota, Utah. Come on, guys, get your act together. And other states out there, they're doing this. So there's a bit of a snowball effect out here. The more you withdraw from pre-tax accounts, the higher your provisional income gets. The higher your provisional income, the more your Social Security becomes taxable. And if you're not careful, you can unknowingly push yourself into higher Medicare premiums too. John, this sounds like an absolute recipe for disaster here.
Yeah, it can be, especially if you're not paying attention to it. That's why I made the comment earlier is if you're in your 40s and 50s and you're asking, why am I listening to this? This has nothing to do with me. It absolutely does, because you can plan appropriately now to help set yourself up in retirement years when you do start taking your Social Security income to where you're not going to, or where you're going to limit, at least at the very least, limit the impact of what this tax can have on your Social Security income. So let's kind of go over some of the common mistakes that most retirees, make, or that cost retirees, during their retirement years. So mistake number one, let's just talk through this. Thinking it's all tax free. We've already clarified that. As we've just discussed, this is rarely the case for high income retirees. But many people don't even think about it. They're so focused. They got that laser focus of where they are just, staying in that lane of work, save, not worried about anything until it's time to start pulling the money out. And when you have those blinders on, it can really create problems. And you're just not thinking that it's going to be taxable. And then you get to retirement, you're like, whoa, I'm in the 85% threshold, or I'm in the minimum, the 50% threshold. And so just remember, it's not guaranteed to be a tax-free benefit. And it hasn't been for a long time. So number two, not coordinating withdrawals. If you take large IRA withdrawals in the same year, you start collecting Social Security, you may be inflating your provisional income and triggering unnecessary taxes. And we do see this sometimes. We do see it that clients will take large distributions while taking their benefit, not realizing, understanding the impact it has on that income. Number three, you're gonna chuckle, Bill. You're gonna laugh, and I think our audience is gonna laugh too, because number three is ignoring Roth conversions. Yes, we said it again, Roth conversions. We talk about this almost on every single episode. One of the smartest moves you can make is to do a Roth conversion before you start Social Security. This can help lower future required minimum distributions, and it can reduce how much your benefit is taxed later. Now, I think here's a great point, or a great part of the episode where we give our usual disclosure that any of the things we talk about today may or may not be appropriate for you. Please consult your qualified financial planner or your CPA or tax advisor. And remember that the information we're sharing today is intended to be educational and informational purposes only. So keep that in mind. And then mistake number 4, taking Social Security too early. By claiming at age 62 instead of waiting until full retirement age or FRA, or even waiting until age 70, you not only reduce your benefit, but you may start paying taxes on it sooner and for a longer period of time. Now, I'm going to pause there. I went through 4 pretty big mistakes that we commonly see. Bill, anything you want to add or tack on to any of that?
Yeah, the only thing about number 4, the taking Social Security too early, is more of a that is probably, I think it's probably listed at number 4 because it's probably the least impactful piece, or the easiest one to work around. Because
Yeah.
if you coordinate withdrawals and if you do strategically utilize Roth conversions, it will probably take care of the Social Security timing issue, because it will help you create multiple streams of tax-free income, which is ultimately the goal here. So, um,
Again, it goes back to my third time now making the point that it doesn't matter what age you are. If you're listening to this podcast, you can plan now to help avoid this mistake later.
yeah, and I think that the key here is we don't want to get focused on, oh, well, I heard on the show that I should wait till 70, so I'm going to wait till 70. That may be
Mm-mm.
the case. That may
Could
work,
be, could be.
but but may not, right? It may not be the reason for this. So I want to make sure that's pointed out.
Yeah,
So
great
we'd
point.
also talk, and I think at this point we probably should just go through the strategies that we can utilize to minimize taxes on Social Security. I think there's some ways that we can take control of this. I know there are because we've done this, right? And we've worked with a number of clients to do this. First of all, I will say that uh, leaving things as they are generally is not a way to fix it. Okay.
Mhm.
Or hoping that it works out. Um, we like to joke in our office and say that hope is not a retirement plan, right? Um,
Correct.
and so I think there's a few strategies that we use with clients here that we should share. Well, you mentioned delaying Social Security. I'm a little lukewarm on this one because, again, I just don't think the age specific part of this is something we should get fixated on. It may
Mm.
work for some people. I don't think that necessarily delaying Social Security. And part of the reason that I'm a bit lukewarm on that is because you have to examine, if we delay when we take Social Security, what kind of stress does that put on the other assets? We have to make sure that's in view. We don't
Yep.
want to delay Social Security in an attempt to minimize taxes at the expense of a longevity part of our retirement plan.
Yeah,
So,
no, I agree. I just want to say real quick on that is I could
yep,
not agree more. I mean, at the end of the day, delaying Social Security, it has to be the right fit, and it's not going to work for everyone, and it won't make sense for everyone. However, on that flip side of that coin, delaying it to age 70 could be a very beautiful thing for you if you are in a financial position to be able to do so. At the end of the day, it really is going to be an individual scenario. And you want to make sure you parse that out. You want to make sure you stress test that on your financial plan to determine whether it makes sense at the end of the day.
yeah, I couldn't agree more. And I think the other part of this is, yes, we joke about the Roth conversions on here, but frankly, the reason we have to bring up Roth conversions so often on here is because we have so few options that we can utilize to obtain tax-free income in retirement. If
Hmm.
if the IRS put a provision in the tax code that said, "Hey, if you invest money in Pixie Sticks, and we'll give you a 10% return on your Pixie Sticks, and all that's going to be tax free," well, we would probably have an asset class that's called Pixie Sticks, right? And we would utilize that as part of the retirement plan. We don't promote Roth conversions or Roth accounts because we love Roth accounts. We promote them because it is a tool that is useful for this purpose, right? And in this case, distributions from Roth IRAs don't count as provisional income. They do
Correct.
not count into that provisional income calculation. So this means you can take money tax free and avoid pushing more of your Social Security into the taxable category. So let's stop here for 1 second, John. The concept of reducing taxes on Social Security plays into a larger concept, which I mentioned earlier, which is about creating multiple streams of tax free income inside your retirement income plan. Our previous episode, episode 22, we talked about retirement income planning.
Yep.
A major component of a retirement income plan that is well thought out, that is created properly, should include multiple streams of tax free income. And if it does, then what will flow into that is you will create a couple of more tax-free income streams, which could be your Social Security. And
Agreed.
the concept of tax-free income and the concept of creating multiple streams of tax-free income is not product specific. We are not talking about specific products here that you need to buy to make this work. We're talking about a strategy that needs to be set up inside your currently existing assets and potentially restructure them in such a way to create multiple streams of tax-free income. John, have I said that correctly?
Yeah, no, I mean, you hit the nail right on the head. And again, I'll say it for the fourth time. It's never too soon to start planning these strategies for yourself. The sooner you start, the more sources of tax-free income you could potentially have when you get to retirement years and start drawing funds off of the supplemental accounts you have created for yourself to create that paycheck in retirement or supplement that paycheck in retirement, thus giving you more options and more opportunity to help keep your Social Security income at if not tax-free, if not allowing yourself to bump it into that tax-free zone, at least keep it out of the 85% threshold potentially. And that's all we're trying to say here, folks. That's all we're trying to say is you've got to plan, though. You have to plan for it.
Yeah, it's absolutely not too early, John. Sorry to step over you there, but
no, you're fine.
Ultimately, the airplane you're flying in while listening to this podcast is not planning their landing while they're over top of the airport, right? They're planning the landing hundreds of miles out. And so planning years in advance for this makes the steps you have to take a little bit easier oftentimes and not as austere in your planning part of this. I'll just say the last piece of this is tax efficient withdrawal sequencing. If you create multiple streams of tax-free income and you then couple that with a withdrawal strategy or withdrawal sequencing that utilizes those in the proper manner, and it doesn't have to just be the tax-free side. It allows you to utilize the taxable and tax-deferred accounts as well, right? So you might consider drawing from taxable brokerage accounts first and then IRAs and then layering Roth accounts in at some point there as well. The sequencing can dramatically reduce your overall tax liability over a 30-year retirement in here as well. So keep that in mind. I'll say this too. We want to manage capital gains and municipal interest quickly, right on that. Even tax-free income like, muni bonds interest can increase provisional income. And then bunch our IRAs together in the non-Social Security years. So if you're delaying Social Security until age 70, use the early retirement years to draw down pre-tax assets strategically without impacting the benefit taxation. So in other words, draw the IRA down so that when you do start taking Social Security and you do have to start taking RMDs later on, required distributions from those IRAs, maybe that doesn't hamper you as far as the income calculations and the tax part of your Social Security later on.
Yeah, absolutely. Well said. So, I'll say this. Social Security was never meant to be complicated. But the tax code makes it anything but simple, quite frankly. The good news is with planning, you can dramatically reduce the taxes you pay on your benefits and potentially avoid them altogether. But again, it goes back to planning and starting that planning and getting those things lined up now. So start by calculating your provisional income, understand where you fall on the scale, then model different withdrawal strategies to see how they affect your Social Security taxability. And if you need help with doing that, we're here. You can call us, you can email us, you can go onto our website and schedule a complimentary review. Anyway, we're here to help if you don't have someone that you trust or that you feel like can help you work through these calculations and work through this modeling and stress testing. And remember, once you start taking required minimum distributions, your flexibility narrows, if not goes away entirely, quite frankly. The best time to act is before you're forced to. That's the best time to act, when you have options. So, yeah. Bill, anything you want to add?
If you want a personalized plan to minimize Social Security taxation, if you want to just see a picture, first of all, of where you are right now and what this particular topic looks like for you, where are you going to fall in the Social Security provisional income brackets, just based on how you're set up right now? Oh, and by the way, when am I going to run out of money? if I'm going to run out of money? How is inflation going to impact all of this? When should I withdraw from my Roth account? If you want to see those types of things in a more personalized approach, we're here. We can help you with that. We have tools that we can use for that. It's the kind of analysis that we do for folks every day, where we integrate income planning and tax strategies and retirement goals. And ultimately, we want to help you keep more of what you've earned.
100%. Absolutely. So, again, thanks for tuning in to us today for this episode. You can always schedule a Social Security tax analysis at crownadvisorgroup.com. That's, again, Crown Advisor with an OR group.com. Click on the complimentary assessment button and go through a few questions and get on our calendar, where we'll be happy to sit down and chat with you about your situation. Or you can always call us at 704-469-0200. Again, that's 704-469-0200. And we certainly look forward to hearing from you. And we appreciate you tuning in today. Bill, you want to add anything else?
Yeah, absolutely. Don't forget, folks, please follow us on Spotify, Apple Podcasts, YouTube. We want to make sure you don't miss any of our future episodes, and you can check out the ones we've already done as well. Thank you so much for your time and joining us today. For John Foard, I am merely Bill Kearney. We look forward to seeing you next time on the Retire Stronger podcast.
Thanks, everybody.